How to be a tax-free millionaire. I'm sure you've heard it said that the only certainties in life are death and taxes. And we have Benjamin Franklin to thank for that bit of wisdom, by the way. And I want to begin by confessing this is generally a true statement. There aren't many ways to avoid taxes and virtually none that get us out of them entirely. However, there are a few cases that come to mind in which the government either allows you to either accept, earn, invest, withdraw, or distribute money without levying a tax against the sum. But when they do this, it's almost always because they're trying to incentivize certain behavior. In other words, there are almost always strings attached that take a lot of the shine and glimmer off the tax-free aspects of these types of accounts or investments. Today, let's talk about several of these account types and how you might leverage them for their tax-free benefits. As we run through these, I'll discuss them in the order that I think is least impressive to most impressive, meaning most least beneficial to most beneficial, and I'll save my favorite option for last. The first one is insurance, and I'm not really sure this one even counts, so I'll move through it quickly. Index Universal Life Insurance allows you to earn tax-free interest and then borrow against the policy, which also doesn't incur a tax. And finally, once you die, your heirs receive the proceeds of the policy completely tax-free. I'm going to be perfectly honest, this is a tax-free way to generate interest. But it's also a really dumb way to invest your money. In this case, where the government loses, the insurance company wins. Oh, and you lose too. You lose because universal life insurance is incredibly expensive to own. You may not pay a tax, but you certainly pay for going this route. Besides, you'll probably be funding the policy with money that's already been taxed. So I'm failing to see any advantage to using universal life insurance as a way to generate tax-free wealth. Also, permanent life insurance is a terrible way to buy life insurance. You want to stick to term life policies which are affordable and they leave you some money to invest for yourself instead of giving it all to your insurance company. Alternatively, if you die while your life is insured, the benefit is generally tax-free, but I doubt you're interested in dying to avoid taxes, so let's move on. So next is inheritance. I'm sorry to stay on morbid topics that involve death, but I'm afraid you're going to see that as a sort of theme in this video. Now first, let's acknowledge that inheritance is generally going to be tax-free, assuming the total value of the estate is below the lifetime exemption amount for the benefactors of the estate. That means the deceased who leave the estate to others. So if you happen to receive money, property, assets, or any combination thereof, you probably won't owe any tax for that inheritance. Now what may be more valuable though is the fact that appreciated assets are also given a free step up in their tax basis when they're transferred as part of an estate. Houses are a great example. Let's assume you inherit a house from your parents after they pass away, and over their lifetime, the value of the home is increased by $400,000. Because the home is an appreciated asset, you inherit its entire value completely tax-free. Of course, if you want to sell it later and it appreciates further, you'll owe tax on that part, but the value when it came from your parents to you is yours to keep. Stocks and other equities work exactly the same way. Unfortunately, once again, the primary drawback is that someone has to pass away for this tax-free benefit to occur, but it is worth noting. Also, the assets transferred in an estate were likely accumulated with money that had already been taxed, but there aren't many other ways to avoid taxes on such a potentially large amount of capital appreciation. All right, third on our list is tax-free investments. There are certain types of investments that receive favorable tax treatment. For example, municipal bonds are not taxed at the federal level and usually not at the state level, and treasuries are not taxed at the state or local level. Now granted, the interest that these investments generate isn't typically very exciting, but this is a review of tax-free options, not of investments that produce big returns. Additionally, there are mutual funds and ETFs that are tax-exempt by owning the munis and treasuries we just discussed. These can be a great way to buy tax-free diversification, but because the returns are modest at best, you should keep a close eye on the fund's expenses so your tax-free benefits aren't quickly outweighed by the cost of the actual investment. Munis and treasuries are both very popular investments for wealthy investors who want to preserve the value of their assets without exposure to taxes. But if you're still building your wealth, I would not consider them a high priority for investing. By the way, if this information is helpful to you, please consider clicking like and subscribe below so our channel can grow and I can keep making content to help people with personal finance. Number 4 on our list is the buy, borrow, and die strategy. Now this isn't a reference to a James Bond movie. Buy, borrow, and die is a real strategy used by wealthy individuals to avoid paying taxes on appreciated assets they would otherwise sell for income. And we've already discussed that the government doesn't tax appreciated assets that we don't sell, and they don't tax them when we die. Well, the government also doesn't tax debt. So by borrowing against assets that haven't been sold, one could potentially avoid being taxed on wealth until they die. So here's how it works. Step 1, you buy an appreciating asset like a home, stock, real estate, art, a Ferrari, whatever. Step 2, you use the asset and its appreciated value as collateral for a loan, which won't be taxed. And step 3, you die. Once you die, your heirs receive a free step up in the tax basis of the asset, meaning they can sell the asset to pay off the debts that are outstanding against it, all without paying a dime to Uncle Sam. Now, of course, you'll owe interest, but if you're wealthy enough to own the assets we're talking about, you'd probably be avoiding a 20% or higher tax rate on the capital gains and income, 32% or higher. So it really comes out better in the long run. It would take an unreasonably high interest rate to be less attractive than those high tax rates. Now, with that said, there are a few problems I see with this approach. The first one is it involves debt. I don't like debt. Borrowing money when you're already rich sounds like buying trouble to me. I'd just rather not do that. The second thing is, once again, you'll probably need to use money that has already been taxed to buy the appreciating assets which you plan to borrow against. This doesn't mean it's a bad plan, but it's not as if the whole balance of any loan you receive will be against unrealized appreciation. Some of that will be actual capital that you put into it that was already taxed. And finally, I know it would depend on the structure of the loan, but what cash are you going to use to make regular payments against the balance of your debt? It probably won't be tax-free cash. I can see this strategy working for highly appreciated assets and exceptionally wealthy people. So maybe if a Brinks truck lands in my yard one day, I'll be able to do something like this. But for now, I'll settle for planting the seed in someone else's mind. Number 5 on the list is health savings accounts, which are completely, totally, and truly tax-free. Here's a summary of the tax benefits of HSAs. First, contributions to an HSA are either tax-free or tax-deductible. Second, contributions through a payroll deduction are also spared Social Security and Medicare tax. That's 7.65% of tax that you get to avoid if it's through a payroll deduction to the HSA. Number 3, those contributions can then be invested, and any earnings on the investments are allowed to accumulate tax-free. Finally, any withdrawals made for a qualified medical expense are also completely tax-free. That means the money goes in, grows, and comes out without ever being taxed. It's pretty awesome, huh? Now, I mentioned earlier when the government allows us some tax benefit, it's generally because they're trying to get us to do something we wouldn't do on our own. In this case, the government wants us to use high deductible health plans. I won't get into a lengthy explanation here, but basically it puts more responsibility for healthcare on us as opposed to the insurance company. We actually have a post about this on our website at markmoney.com. I'll put a link in the description below. We have a video form too, which I'll link above. Basically, all this means that you can't really get the completely tax-free benefit unless you use the money for medical treatment, which is a lot less exciting. But even if it's reserved for only one category of spending, it's still tax-free money, and it's an awfully big category. I've seen estimates that in 2024, if you're age 65 or older, you can expect to spend around $350,000 on medical care for the rest of your life. That's a lot of money, so $350,000 completely tax-free is nothing to sneeze at. All right, the sixth and final category we're going to talk about are Roth accounts. These have tax-free earnings and withdrawals. Now, Roth accounts are available in many different types. You can have a Roth 401k, 403b, 457, TSP, or IRA, just to name a few. And all these tax advantage accounts share the same characteristic of having contributions to the accounts taxed, while all the earnings and withdrawals can later be made completely tax-free. Now, there are people who would disagree that Roth accounts are special from a tax perspective, but I think they're quite unique. And if I were to summarize what I love most about Roth accounts, it's the freedom they provide. Take inheritances, for example. Yes, they are tax-free to you as an heir, but don't forget that someone had to pass away for you to receive that, and you didn't have any control over how those assets were distributed or when. We talked about insurance. Yes, again, completely tax-free, but it comes at a completely unreasonable cost in the form of exorbitant premiums. HSAs, I love them, but again, very limited tax-free scope, and you need to be able to prove that you use the money for a qualified expense. That's not exactly free to me. Now, the other strategies we discussed were also funded with money that had already been taxed, so there's no real advantage over the Roth there. Plus, there's complexity in the buy, borrow, die strategy and paltry returns in buying tax-exempt securities. But with a Roth, once again, I pay Uncle Sam his share, I get to abruptly point to the door and tell him to get out, and he has no more claim on this money. It's all mine. One of the greatest examples of this freedom being used to maximize its value is Peter Thiel. Okay, I'm going to sidebar for a second. I really don't know how you pronounce Peter's last name. It could be Thiel, Thiel, I don't know. Peter funded his Roth IRA with $2,000 of stock from a startup company that he called PayPal. Maybe you've heard of it. Today, Peter's Roth IRA is now worth a cool $5 billion. Now, yes, that balance will be subject to estate taxes one day, but what is that to Peter Thiel? In the meantime, he can use that money at will, completely tax-free. He won't even have to pay RMDs on the balance when he reaches his mid-70s. There isn't a better place to have a large chunk of wealth than in a Roth IRA. You really have the freedom to do whatever you want with it without worrying about taxes for the rest of your life. So even if you aren't ever able to truly be a tax-free millionaire, there are certainly ideas in here you can use to set aside tax-free money for your retirement, for your future. We have tons more information about strategically using Roth accounts on our website. I think like 1 in every 5 videos I make is about Roth accounts. Just use the search field on our website in the upper right corner of really any page that you're on. There's also a playlist, which we'll put a link to down in the description below here. As always, I am grateful for your time and your interest in our videos. God bless and take care.